U.S. Treasury market under pressure. What's behind the loss of appeal? Investors move away from traditionally safe assets and seek alternatives as trade and political tensions rise. U.S. Treasury bonds, traditionally seen as a safe haven for investors, faced an unexpected reaction in early April. Amid the turbulence caused by President Donald Trump's imposition of reciprocal tariffs, the prices of Treasuries fell, contrary to their usual behavior of rising when other markets, such as stocks and cryptocurrencies, experience losses. Historically, U.S. Treasury bonds were viewed as the safest option during times of crisis, with investors flocking to them to protect their capital. However, last month, Treasuries followed the decline of riskier assets, raising concerns about the true nature of their safety. The surge in Treasury yields, which saw the largest weekly increase in over 20 years, was interpreted by some analysts as a sign that the market is reconsidering the reliability of Treasuries as the world's risk-free asset. Several factors have been pointed out by analysts to explain this unusual behavior, with a focus on the impact of Trump's tariffs. The inflation generated by the additional costs of tariffs, especially those that remain on Chinese products, could reduce the real value of future Treasury payments, affecting their appeal. If inflation is accompanied by economic stagnation, known as stagflation, monetary policy could enter a period of greater uncertainty. Additionally, the demand for liquidity in cash, considered a safer option during uncertain times, has led investors to seek other assets, such as U.S. money market funds, which have reached record levels. The perception that Treasuries may not be as safe as before has contributed to this shift in market behavior. The political instability in the United States, fueled by Trump's unpopular decisions and volatile economic policies, has also created uncertainty among investors. The difficulty in predicting government actions and the impact of tax reforms have led to a reassessment of the appetite for U.S. assets, including Treasuries. While some experts believe that the current situation is temporary and that Treasuries will remain a fundamental investment for the global financial system, others see recent movements as the beginning of a broader shift in the global economic landscape. With rising trade tensions and expansionary fiscal policies, investors are being challenged to reconsider the foundations that support the U.S. government debt market. The situation surrounding Treasuries has significant implications not only for financial markets, but also for the global economy. U.S. Treasury bonds are used as a benchmark for the pricing of a range of assets, from stocks to sovereign bonds, and their decline could affect everything from interest rates to confidence in the international financial system. Ultimately, the loss of appeal of Treasuries may reflect the uncertainties that are shaking the U.S. and global economy. Despite their liquidity and market depth, investors are increasingly aware of political and economic risks, which could lead to a reevaluation of the dominant assets in the global economic landscape.